So our next speaker today is Matt Whineray, who is the CEO of the New Zealand Super Fund, and he's going to talk to us about the recent reset of the responsible investment compass. I think some of the outcomes in terms of carbon reductions in the portfolio, etc., came earlier than expected. So that might be one of the motivations for being even more ambitious, but we'll hear more on that. Thank you, Matt, for your time.
Thank you, Sebastian, and kia ora koutou. Ngā mihi nui kia koutou katoa. A couple of years ago, when we were all able to stand in the same room, I created some genuine discomfort through an audience participation exercise that looked to reveal people's preferences around climate change investing. And so I guess one of the few upsides of the pandemic is that we are virtual now, and you won't be subjected to any more audience participation. But I am aware it's now 4:13, end of a long day, so feel free to stand up. I've decided to stand up. I listened to Grant Robertson this morning, and since then I've been sitting down talking to my board in a virtual board meeting all day. So yeah, stand up, move around, get some blood flowing. Last year, in Commercial Bay, I was talking about the Sustainable Finance Forum roadmap, which was just in the process of being released at that point. And so we're delighted at the Guardians to be supporting Otago University and putting this day on again. And I'm delighted to come and have a chat to you about what we've been doing on what we call the RI Compass project, which is a bit of work that we did over the course of the last 18 months, roughly, about the transition that the Guardians has been making from responsible investment to sustainable finance, and why we're doing that and what it means. So back in 2019, we established a strategic priority to review our responsible investment framework, and we called that this RI Compass project. Our existing RI framework was established back in 2006, 2007, and had been incrementally developed since then, including with the introduction of our climate change strategy in 2016. And I wasn't going to spend a lot of time, Sebastian, on those carbon targets. We certainly did increase the ambition of the reductions in our overall portfolio carbon footprint recently, but that's not the focus, not in particular the focus of this RI Compass work. The goal of this RI Compass work was to develop an RI strategy that would serve us for the next 15 years, as indeed our framework has for the last 15 years, one that's feasible to implement and oriented to maintaining our license to operate over the long term. So it was a bit of an opportunity for us to just stand back, look at how the responsible investment environment had changed over the last decade. Clearly it has. We see that in the productions from the reduction of reports from RIA, and also Barry's great work over time. We've seen that move, but also for us to establish what is the current best practice, and also to ask what our stakeholders expect. And it's a lot, as it turns out. And also think about how we could then turn that into an actionable plan to take us forward, and not just something which is a bit fluffy and marshmallow-like, but something that has got some genuine meat on the bones in terms of the way in which we make investment decisions. And when I talked about the Sustainable Finance Forum last year and a bit the year before, that's the key thing we're trying to achieve in that, which is we have to change the way in which investment decisions are made. And by which we mean incorporate longer term considerations, incorporate externalities, so that we are truly incorporating the impact of those decisions, not just the impact of long-term environmental or social trends on our investment portfolio. And that's the big switch, the big RI to sustainable finance switch. And so in terms of why we're doing that, I talked a bit about these things that have changed, but what has changed? Well, clearly recognition of the importance of ESG. Responsible investment has become much more mainstream. That board meeting I was just on, one of my board members told me that only a few years ago it was a cottage industry. I disagree a little bit with that. That is the thesis, but certainly you don't have to go back too far before you had a lot of people telling you that, no, I don't have to consider that because that's somehow non-financial, whatever that means. But now almost all managers claim some form of ESG activity. You see ads for responsible investment strategies on TV in prime time. From its inception in 2006, the UNPRI, now just the PRI, has had more than 4,000 signatories globally. It took them 6 years to get to 1,000. The last 1,000 they've done in the last year. So clearly the pace of change is increasing. And that's a trend that we've also seen in Aotearoa. So the 2021 RIA report on ESG investing in New Zealand noted that the RI AUM, or ESG AUM, grew by nearly 30% versus total farm growth of some 11%. So big recognition of the importance of ESG, central to investment activity as opposed to it used to be peripheral. Secondly, significant improvements in data, and you've heard a bit about that from some of the earlier speakers. So proliferation of data sources and ESG ratings, as you've also heard, not all of them that well correlated, but developing rapidly. So this data allows the use of ESG factors more directly in the construction of portfolios and in the monitoring of ESG performance through time. And it is improving through time. You know, one of the things when we implemented our climate change investment strategy 5 years ago was we used to get this question, which is surely the data is a bit ropey and do you know enough? And the answer was, well, we do know enough, and the data will improve. And indeed, we've seen that as we've tried to work with it through those last 5 years. The third thing I mentioned, stakeholder expectations as a key part of a driver for us, but clearly stakeholder expectations have changed. In the last 2 years, we've had a judicial review case in the High Court, our first, which was challenging the legality of our responsible investment framework and our application of it. And fortunately, the judge in that case supported both the legality of the framework and the way in which we've been applying it, which was very gratifying for the team. A significant amount of work goes into actually making these decisions and putting into practice this framework, which is really important. We saw that a few years ago. A bunch of KiwiSavers get tripped up by having a policy, but forgetting about it once it had gone in the drawer. We've had a couple of appearances this year in front of the Foreign Affairs, Defence and Trade Select Committee. This is a select committee we'd never been in front of before. We've always been in front. Our usual one is the Finance and Expenditure Committee, but we've appeared before that now twice to discuss our approach to exclusion and engagement. We've had a big increase in the number of Official Information Act requests that relate to responsible investment matters. We get a lot of questions on RI, and we've had multiple media mentions for RI as well. So we've really seen a step change in stakeholder expectations. And the last thing that's changed is clearly growth in interest in impact investing, and hence the name of today's session. You know, so sometimes impact, sometimes positive, but where that investment decision is being made to achieve a particular environmental or social outcome, either with or without a commercial return. And this is also related to that point about data. The greater ability to measure impact than there has been in the past helps the growth of this. We see it also in addition with the use of things like the EU taxonomy and other frameworks, which have made a bit more confidence around what it says on the tin, as Rob Everett at the FMA, or when he was at the FMA, Rob, has said in the past. You know, those frameworks that give confidence to investors that what they're doing or what they're hoping to fund will actually turn into an outcome are really, really important. And I noticed that was one of the biggest drivers for the minister this morning. He said he in relation to this green bond program that the government set up, really don't want to be accused of greenwashing. And so that ability to measure and report and actually connect the investment with the impact is certainly helping in that interest in impact investing. So a bunch of things have changed. And so we went to the board and said, we're just going to work through this process. We'll go and talk to our stakeholders. We're reviewing how we report on ESG performance of our portfolio and what are the opportunities for us to change that through time. And then we're also having a really hard think about positive investment and how does that fit with our mandate and how does it fit with best practice investment management practices that we see around the world, and where does that get us? And so the culmination of that conversation was back in June of this year, where the Guardian's board approved our new sustainable finance strategy. And it sounds a little bit semantic, but hopefully, with all the discussion you've been having today, you'll understand this point, which is the difference for me between responsible investment and sustainable finance is responsible investment historically, and this fits on Barry's spectrum he was just talking about, has really focused on what's the impact on my portfolio of these things: environmental trends, climate change, social outcomes. Sustainable investment asks that, but it also asks the next question, which is, what's the impact of my portfolio on those trends? And that's where the transitions come. And that's what we saw as we went through that Sustainable Finance Forum work over the course of the last couple of years, leading up to November last year when we released the roadmap, is there'd been quite a shift. And that's where we are now. So we agreed that broad strategy with the board. And now we've got a bunch of work to do to turn it as a sustainable. And to do that, we've been following that Sustainable Finance Forum three-pronged approach. So the roadmap was very helpful in taking our board through this conversation. And that covers changing mindsets. So we've got to incorporate sustainable finance into our SIPSA, the Statement of Investment Policies, Standards and Procedures. Incorporate the new CFI-RI framework into our approach. You heard about that from Lucas earlier. And incorporating these concepts also into our purpose and vision, because it's fundamental that our team have this as a central part of our long-run investing purpose. So that's changing mindsets. Secondly, transforming finance. We've, as you've heard, signed up to the Paris Aligned Investor Initiative, a net zero 2050 aggregation of asset owners. And so we've got some work to do on how we achieve net zero by 2050. We need to report back under that initiative in the next 12 months. We're also reviewing how we construct our portfolio to achieve better ESG performance, including defining, obviously, what we're looking to improve, but also how we're going to make that manifest, particularly in our listed portfolio. So that's transforming finance, changing mindsets, transforming finance. And then the third one is financing the transformation. And financing the transformation is about positive investment. So having agreed with the board that positive investment met our mandate, as long as we were able to generate both positive investment outcomes and commercial returns. And critically, that we are thinking about intentionality and additionality as we do that investment, including in that measurement and reporting options, how we're going to measure that, what data is going to be helpful for that, and actively looking to increase our allocation to investment for positive outcomes. So we've got 3 work streams under those 3. It was very useful that, another shameless plug in the long list of shameless plugs from today, using that Sustainable Finance Forum 3-pronged approach, changing mindsets, transforming finance, and financing the transformation to organize those conversations with the board was extremely helpful. I just add one more point before I finish on the RI Compass work, and this is a continuing task for us. This is the implementation of this strategy will take us the next couple of years at least, as we get deeper into just how we do it and how it reaches into all parts of our portfolio as well as the operations of the Guardians. But something that the board is particularly committed to, and something that, as I say, is incorporated now into our purpose and vision as a long-term investor. There was a question this morning from, I think it was Ken Allen, to the Minister, which was asking whether or not the framework, the CFI-RI framework, ought to be applied to community trust, or was going to be applied to community trust. And of course, you don't need to wait for it to be applied. But that framework is a pretty useful one. It's just focused on climate change, but it's attached to a letter of expectations that the CFIs have all received from the Minister. And there's a couple of pages of letter, but the framework itself was only on 1 page. And it's a really simple construct, which all of your investment committees could incorporate or easily consider. And it covers the measure, reduce, and influence. So it goes a little bit to some of those different aspects of ESG that Barry was talking about, but measuring your footprint, reducing your footprint by setting targets around the near term and 2050, and influence, which goes to engaging, because ultimately, as investors, we need companies to own the change in the emissions. We can change our portfolio emissions footprint, but we need the companies to do it for the real economy. And so that last bit, that influence, is really critical and fundamental to how we operate, and fundamental to how we're all going to get to net zero. It's not just going to be by a bunch of investors selling our shares to someone who cares less about the carbon footprint of their portfolio. It's going to be through that engagement with companies. Sebastian's told me 4 minutes, but I'm going to give him 4 minutes back, and I'm happy to take your questions. And I really am jealous of Otago and all those people outside of the moat of Tamaki Makaurau who are able to not hang out in their home like I am.
Hey, thank you so much, Matt. And thank you for giving those minutes back. Actually, we've been a little bit behind all day, so it's quite a good feeling to be on time for one of these sessions. And yeah, it's obviously great having the freedoms we have down here, but as I can show you, the room is fairly empty right now. So a live audience is always more fun.
The freedoms.
Yeah. But we do have lots of people online still, and some questions for you. So the first question is the New Zealand Super Fund looking to increase the exclusions to human rights valuations and other exclusions based off the work of Mindful Money and RIA that we saw in the previous presentation?
Yeah, so look, human rights is one of 4 critical or key categories that we look to engage and review companies on in terms of corporate practices. So we've got these 3 different categories of exclusions. We've got the product ones, which is people are making something like a cluster munition and you just can't own the company. We've got the state ones, which relate to sovereign bonds, where they are subject to New Zealand sanctions. And the third one is corporate practices. We are doing a lot of work in that space across the portfolio to review, get the data, review the corporate practices, and consider them versus the UN Global Compact, which is the standard that we use. I expect that, and then the process that we go through with that is we will typically look to engage, unless we think that engagement is a complete waste of time. We know for some other reason that we're not going to be able to get any change, but we will start with looking to engage, and we use a provider that works jointly for the CFIs, called BMO, that helps us with those international engagements. We do domestic engagements ourselves. And then if we get to the point where we can't actually see any change, and those engagement processes can take quite a while, as I explained to the Select Committee earlier this year, they certainly take longer than a Select Committee cycle, they take longer than a media cycle, and that can cause a bit of frustration, but ultimately that's our go-to in terms of changing practices. If we get to the point where we're not going to see any movement, then we exclude them. And so that's where you see them come out the end of the pipe, if you like, but that pipe itself has a lot of work going on and can be quite long.
Thank you for that. Just a question which I sort of asked Barry earlier as well. What ESG data source providers do you use, or do you use more than one?
Yeah, I heard your question to Barry, and I was thinking, well, we definitely use MSCI. I think we also use Sustainalytics as well, but we definitely use MSCI for the data, the data sources on our large global passive portfolios.
Thank you. So next we have a question from Chad. Hi, Matt. How does the Guardian strike a balance between economic efficiency and mitigating conflicts with stakeholders, the New Zealand public, ministers, etc., when deciding to when deciding to make investments or influence businesses? So
how our RI framework works when thinking about exclusions is that first category I talked about, which is the product ones, where that is entirely informed by New Zealand laws. So that's the expression of the New Zealand voter through Parliament, international conventions that we're subject to, and major bits of government policy that are really sort of bipartisan. So that's the tobacco exclusion, for example. So those ones we don't really strike that balance. We say, look, those things inform it, and if they fall into those categories, we exclude them without engagement. The bit about how do we strike the balance is we're informed by the activity of our stakeholders, and they express views to us quite consistently. But what we have to think about in the engagement decision is what's our likelihood of being able to achieve some outcome here? How big is the impact on the portfolio? And that's one of the things that we're starting to think about a little bit more, which is we have a long tail of quite small holdings, and the engagement can cost you more, frankly, than the value of the holding over time. So, it really is a bit of an economic question in there, whether you just get to the point where you say, actually, that's just too hard and we might exclude. But there is, firstly, in the first instance, we're informed by all of our stakeholders. And the second one, they do get a bit of economic efficiency input into that.
Great, thank you. Maybe a couple more questions here. Another one from Graham, who's been very active today. So thanks for that, Graham. He said, excellent presentation. Thank you, Matt. What is the shadow price per tonne of CO2 equivalent the New Zealand Super Fund is using today for portfolio company risk tracking? And what's the price that you'll use next year, the following year, etc.?
I'm going to put my hand up here, Graham, and say I hope that Lucas is still around because he can answer this for you. I'm sorry, I don't know the answer to that, but we can get that back through the forum.
Thank you. And a question by Paul. The New Zealand Super Fund rightly has a view of New Zealand exposure that relative to the market opportunity set, at least in equities, it should be zero. How will that translate to sustainable finance? The impact opportunity is outside New Zealand. So that's where your sustainability efforts will focus. So essentially, I guess he's trying to ask whether you will invest mainly overseas to have your investment impacts.
Yeah, that's a good question. G'day, Paul. Paul used to work for us as well. Our impact to date has been, by dollars, has been much more in the renewable generation development space, and that's been the US in particular, and also more recently Europe. At a local level, we have done a number of impact bonds. We did a recidivism impact bond, the Genesis social bond. In New Zealand, we've also through our internal credit mandate bought a number of green bonds, as well as Asian Development Bank gender bonds and women's livelihood bonds. So those things tend to be a little bit more offshore, but this is a live part of that conversation around that third stream, that financing the transformation, which is how do we think about positive investment? What outcomes are we looking to achieve? And where also the challenge we get from our board is, where can you find some scale? Because one of the challenges, for example, of the Genesis bond is it's small, but a lot of impact ultimately ends up being local. So how do we find some scale to achieve some of those outcomes? And that's probably one I might answer next year if I'm back. I can talk about where we've got to in terms of that positive investment strategy.
Yeah, that'd be great. So I think we'll leave it there with this session. Thank you very much, Matt, for your time. I know you've been on Zoom all day in meetings, and now you've been on Zoom again, but we really appreciate your time and insight into what the New Zealand Super Fund is up to as one of the leaders in the space.